The weighted average cost of capital. A whack attack, if you will. Companies can get monies from about four places. First of all, profits, from borrowing money, debt, from common equity stock, if you will, and even sometimes preferred stock. Let's take the case of just debt and common equity. Well, the debt is tax deductible, so let's adjust for that. And the cost of equity can come from the valuation model for common stock, where we solve for K, the discount rate, and we're going to label it appropriately for equity. And if you think about it, the cost of equity is always greater than that of debt. And also, think about it, they both rise as the firm borrows more money. Well, in this two-source case, we would have the weight in debt times the after-tax cost of borrowing, and the weight in equity, which is the yield plus the growth rate for common stock. And we do note, of course, that the weights add to 1. That also means that if we know the debt-asset ratio, which would be the cost of debt, the cost of equity would be the remainder. And, of course, here's an example. And again, no preferred stock. Let's say the debt-asset ratio is 30%, tax rate is 20%, interest rate in the bonds is 5%, a lot of percentages, eh? And we have common stock paying a dividend of $3 on a share price of 100, growing at 4%. Here, our weighted average cost of capital, I'll label it KA, would be that 30% of the cost of the debt after tax, and the remainder, that's 70%, with a dividend yield of 3% plus 4%, that makes 7. Well, cross-multiplying, we get a weighted average of 6.1%. Let's do a little more complicated one, this time with preferred stock. Tax rate the firm faces is 25%, interest rate on those bonds is 8%, pays a $5 dividend on common stock of $50, growing at 6%, and now with the dividends on the preferred of $8 at a price of 40. This time we're going to get the weights by looking at the market, not book value, of each of the components. We have 25 grand in debt, 5 grand in preferred, and 20 grand in common stock, totaling 50 grand. So the weights, of course, are 0.5, 0.1, and 0.4, respectively. Well, therefore, the cost in debt after tax is 6%. The preferred is the 20%, 8 over the 40, and the common is 5 dividend dollars over the 50 share price. That's 10%, plus 6 makes 16. Well, let's weight these each to get the average cost of capital. Well, turns out 11.4%. But wait, there's more. What this really is all about is we can vary those weights and determine what's called the capital structure. Now, very counterintuitive. Notice both of the components rise as you borrow money. The firm is riskier. And yet, there could be a place where it drops to a minimum which betters the firm. That's something with Dr. C Invests.